What if I told you there are stocks with serious upside potential, backed by Wall Street's top analysts, and most investors just overlook them? You're probably thinking it sounds too good to be true, but these 5 stocks have numbers so extreme and so exciting, I had to double-check them myself. Every single one has unanimous strong buy ratings from analysts who matter the most, and one of them has projected earnings growth of over 200% this year. Let's break down why these could be the biggest stock market opportunities in the near future. By the way, my name is Steve Reitmeister. I was editor-in-chief of Zacks.com for over a decade, and I'm currently a partner at WallStreetZen.com. I've been doing this for over 40 years, why I've seen every market cycle, every bubble, every crash, and I use these lessons learned to pinpoint the best stocks for the current market environment. Please note that I don't throw around predictions like this lightly, but when our proprietary in-house quant model, the Zen Ratings, lines up perfectly with Wall Street's sharpest analysts, I've learned to pay close attention. These aren't lottery tickets. These are fundamentally sound companies at exciting inflection points, right? Before we get rolling, hit that like button down below. That's because I cover stock picks like this every single week, and you don't want to miss any of my next videos. Okay, let's get into it. First up, we have Eli Lilly with a symbol of LLY. Yes, it's already over $1,000 per share, but here's what really matters. Wall Street's top analysts see 40% or more upside in the coming year. Why? You know why. Because Lilly isn't just riding diabetes wave. They're dominating the obesity market, which is one of the largest and fastest growing healthcare segments on the planet. Let me paint the picture. Lilly's GLP-1 drugs, Mounjaro and Zepbound, are posting blockbuster numbers in both diabetes and weight loss. We're talking about a market that could hit $100 billion globally, and Lilly is positioned right at the center of it all. Their product pipeline is loaded. New diabetes medications are entering late-stage clinical trials with results expected in 2026. And recent earnings momentum has been truly exceptional. Even better, management keeps raising guidance for the future. This has led Eli Lilly to make a massive investment to rapidly expand manufacturing capacity to meet this exploding demand. Now let's talk about what the data actually says. The Zen Ratings gives Lilly a B rating, which equates to a buy recommendation. That's because it's currently in the top 10% of all the stocks we track. When you dig into the component grades, the story grows in appeal. Value scores a B, placing them in the top 20% of all stocks. Growth is also a B, in this case the top 15% of the stocks we cover. Momentum is a notch higher in the top 10% of the ratings universe. This company is truly firing on all cylinders. Just take a moment to consider this. Our value rating uses 21 different metrics to determine how a stock's valuation stacks up to the rest of the market. Amazingly, Lilly is up almost 400% in the past 5 years, and yet it still qualifies to be as good or better than 83% of the stocks in terms of value. That means the valuation has not come up as much as earnings, and that's the bright light that points to more upside ahead. Lilly is also a top-ranked stock in the general drug manufacturing industry, which itself has an A rating. That tells you it's not just a good stock, it's a top performer in a strong sector. Wall Street is picking up exactly what Lilly is putting down. Out of 17 analysts covering the stock, you have 11 with strong buys, 3 with buy ratings, and 3 at hold, and nobody sees it as a sell. Now, let me give you some specifics from the analysts who actually matter. The ones with the top stock-picking performance track records. Now, Guggenheim's Seamus Fernandez is in the top 2% of all analysts based on his stock-picking performance. He recently maintained his strong buy rating with a price target that suggests ample potential upside in the coming year. His take, Eli's fundamentals are robust, and channel checks with investor relations and recent management commentary support his bullish case. JP Morgan's Chris Schott, who's in the top 12% of all analysts, he set a bullish price target that's just about 25% potential upside from current levels. He sees sustainable runway for significant growth and is banking on the company's gaining market share in, I quote, still very underpenetrated obesity market. I could keep going on and on with the top analysts, but it's really worth pointing out that it's the street high target price is $1,500. That's over 40% upside from the current level. Now let's talk about risks. Any earnings miss or pipeline delay could trigger ample profit taking. Plus, competition is heating up. Novo Nordisk isn't standing still in the GLP-1 space, and there's always regulatory risk with any pharma company. But given the market size and Lilly's execution track record and the strength of their pipeline, these feel like very manageable risks. And so the bottom line is Lilly is a pharmaceutical powerhouse firing on all cylinders in 2 of healthcare's fastest growing markets. When the Zen Ratings gives it a B with top-tier component grades, and when Wall Street's best analysts are calling for $1,300 to $1,500 price targets, you don't ignore it. This is the kind of core holding that could deliver deliver 40 to 50% upside in the coming year and a double or more in the long run. Next up, we have Hillman Solutions with a symbol of HLMN. Shares are trading under 15, and gladly the average price target from Wall Street's analysts suggests over 30% potential upside, while the max forecast suggests close to 50% appreciation potential. Now, why is that? Hillman is found everywhere, but you've probably never heard of them. They supply fasteners, keys, key-cutting machines, and hardware accessories to just about every major retailer in North America. We're talking about record sales, explosive earnings growth, unanimous strong buy ratings. That's a winning combination. This is a hidden infrastructure play. It's not sexy, but it's essential. Think Home Depot, think Lowe's, think Ace Hardware. This is their customer base, and Hillman benefits from sticky long-term relationships with repeat purchasing. They just posted record quarterly sales of $425 million. But here's the number that should make you sit up and pay attention. Forecasted one-year earnings per share growth is expected to be 203.75%. Let that sink in for a second. 203% earnings growth. The industry average, who really cares? It's 15%. Obviously, we are leagues and leagues ahead, meaning that Hillman is growing earnings 14 times faster than the industry average. That kind of growth differential sets you up for serious multiple expansion and price appreciation. Management is executing extremely well. Their margin expansion initiatives are paying off. Boring business, yes, but exciting numbers, also yes. The Zen Ratings is also excited about Hillman, where the score overall is an A, which equals a strong buy recommendation. Like our other picks today, this is a top performer in a strong industry. Specifically, they are the second highest rated stock in the A-rated tool and accessory industry. The component grades here are also exceptional. Growth scores a hearty A in the top 5% of all stocks. AI Factors is a solid B in the top 20% of all stocks. If you aren't familiar with what our AI factor means, it's a measure of how likely the stock is to be an outperformer based on our in-house neural network, which was trained on more than 2 decades of market data. The slew of C ratings for Hillman might seem discouraging, but it's actually much better than it appears. For example, Sentiment scores in the top 30% of all stocks. Financial is in the top 25%. Safety is not too shabby in the top 24%. So yeah, it's C rated, but all in the top tier of all stocks we analyze. Now, on the Wall Street side of things, there are 2 analysts covering the stock. Both have it a strong buy. That's a very nice 100% strong buy consensus. Canaccord Genuity analyst Brian McNamara, he's in the top 24% analyst based on his stock picking performance. He recently maintained a strong buy rating with a price target that suggests nearly 50% upside potential. Here's his key takeaway in the stock. Hillman's strategic positioning in the industry remains strong, with potential for significant upside. Solid fundamentals underpin our bullish outlook. Right now, the market is valuing it like a mundane, slow-growth hardware supplier, yet if they deliver on that 203% growth estimate, the multiple will expand and the stock will reprice much, much higher. That's how you get that 46% upside projection. Let's be real about the risks. Hillman is a smaller company with just a $2 billion market cap. That means less liquidity and a bit more volatility. That 203% earnings growth forecast sounds incredible, but small cap forecasts can be volatile and certainly not set in stone. Analysts could get it wrong. A miss on those numbers could be very painful for shares. Then again, this is the kind of overlooked small cap that can quietly double while everyone's chasing the latest AI stock hype. The fundamentals are there. The ratings are there. The analyst support is there. The opportunity is absolutely there. The only question is whether the risk profile is right for you. Moving on to our next stock, we're talking about Vistance Networks with a symbol of VISN. This is a turnaround story with jaw-dropping numbers. Never heard of it? Well, it used to be called CommScope Holdings until mid-January. Long story short, that business sold off several segments, decided to focus on core competencies, and rebranded itself as Vistance. Shares are up approximately 560% from their 52-week low. Yes, 560%. That's not a typo. Why is that? Q3 earnings shines a light on their impressive growth. They didn't just beat expectations, they crushed them. Now, that's a company emerging from a restructuring with some serious earnings momentum. What do? Vistance provides critical infrastructure for communications, data centers, and entertainment networks globally. Plenty of secular growth trends are acting as wind behind their sails. There's also a major operational turnaround in progress that includes strategic divestitures, cost restructuring, and focus on the core business, and it's clearly working. As I mentioned, the Q3 2025 results were exceptional. Earnings per share came in at 62 cents versus the 37 cents that were expected. That's a stellar 68% beat. Revenue is on fire, growing 50.6% year over year, about 15% above expectations. Even better, adjusted EBITDA was $402 million, up 97% year over year. Let me say that again, 97% year over year EBITDA growth. This led management to raise their full year guidance for the year ahead. All business segments are delivering strong results simultaneously, and the balance sheet is improving as the restructuring rolls out. And here's the market validation. The stock surged from $2.94 to $19. Investors are waking up to this transformation, and gladly, signs still point to even more good times ahead. Now let's look at their quant ratings profile. Not only is the Zen ratings an A, meaning strong buy, but Vistance is also the #1 ranked stock in the attractive communication equipment industry. Their component grades also sparkles thanks to strength of this turnaround story. This leads to A ratings for 3 prime areas such as value, growth, and sentiment. They also score in the top 20% of companies for 2 other key components of momentum and financial strength. Now, safety and AI are both C, which reflects the ongoing balance sheet work that's understandable and expected for a company at this stage of their transformation. On the Wall Street analyst side, there's only one covering the stock. Sadly, its top-ranked Taliani of Bank of America was in the top 14% of all analysts based on his historical stock-picking prowess. He has a strong buy rating with a price target that suggests ample upside from current levels. You may think that limited Wall Street coverage is a negative, but history shows that companies growing like Vistance typically pick up new buy ratings that helps propel shares even higher. The downside, well, this is a turnaround and execution risk remains. And that 506% run-up in shares means a lot of easy money has already been made. Any stumble in results could lead to a hefty round of profit-taking. But when growth metrics are this strong and the trend is this clear, the risk-reward strongly favors the bulls. If you can stomach the volatility, this one deserves a spot in your portfolio. If you're not 100% sold, you can always add Vistance to your watch list. Speaking of adding, why don't you add yourself to the elite population of investors known as subscribers to this channel? Go ahead, hit that subscribe button down below now. Let me move on to stock number 4. We're talking about FedEx with a symbol of FDX. This is obviously a well-known company, but that doesn't mean that it's receiving the proper attention that it deserves from investors. Now, hear me out on this one. This is a stable, dividend-paying blue chip. It's also well-positioned at the intersection of 2 massive tailwinds. We're talking about e-commerce growth and international expansion. Speaking of which, they just announced a consortium to acquire InPost for $9.2 billion. This is a major European parcel delivery play. The e-commerce boom is structural, not cyclical. Online shopping continues to take a share from brick-and-mortar retail. That's a tailwind that isn't going away anytime soon. But international expansion is the real story here. Management is targeting high-growth emerging markets where logistics infrastructure is still being built out. The InPost acquisition is a $9 billion bet on European automated parcel lockers. That's a smart strategic move at this time. Parcel lockers solve the last-mile delivery problem in dense urban areas. It's exactly the kind of infrastructure play that compounds growth over decades. They're also seeing operational improvements like efficiency gains across the network, leading to better profit margins. Recently, quarterly results are showing consistent execution, meaning that management is delivering on their promises. And here's a piece of the puzzle that most people are missing, that being the small and medium-sized enterprise adoption is accelerating. This is a huge market segment where FedEx is winning. The Zen ratings also smiles in FedEx, putting in the top 5% of all stocks based upon the strength of the fundamentals. This equates to an A or strong buy rating. The component grades show balanced strength. Growth is a B in the top 20%. Momentum and sentiment are even better in the top 15%. Now, the secret for value and financial strength may create some pause, but when you appreciate that it still scores in the top 25% for both of these vital categories, then you understand that across the board, our AI-driven quant review of the Zen ratings finds no red flags for the stock. Wall Street is also quite bullish on FedEx. Out of the 17 analysts, we have 10 strong buys, 6 at a hold, and 1 as a strong sell. That is a good Wall Street profile overall, but it's great who is actually bullish on these shares. For example, Citigroup's Ariel Rosa in the top 3% of all analysts recently maintained the strong buy rating. The assessment is as follows. FedEx has presented consistent growth metrics and is set to gain from e-commerce and international expansions. Barclays analyst Brandon Oglensky ranks in the top 5% of all analysts based on his stock picking performance. He is pounding the table with the street high target price. That's because his love for FedEx flows from them capturing incremental and lucrative B2B market share. So what's the catch with these shares? Logistics is economically sensitive. If consumer spending weakens or we hit a recession, package volumes will clearly drop. The InPost acquisition is expensive at $9.2 billion, and it adds integration risk given the size and complexity of the operation. Labor costs are rising for everyone, plus there's competitive pressure from UPS, all the while Amazon's in-house logistics network continues to expand. But FedEx has a lot going for it. It's the number one rated logistics stock, has a wave of enthusiasm from top-rated analysts, and has made ambitious strategic moves to expand its competitive moat. This isn't a mood shot. It's not going to double overnight, but FedEx isn't going anywhere. It's a methodical, steady growth compounder positioning in a secular growth markets. Plus, the greater than 2% dividend yield is a nice cherry on top of this investment equation. When you lay it out like that, it's clear where the appeal is to the stock. Want quality growth and share price upside without taking unnecessary risk? Well, FedEx delivers. Pun absolutely intended. By the way, these 5 stocks came from deep research using the Zen ratings. You might be interested in knowing that I use the same system to unearth 3 stocks that could double in the coming year. Get your copy of this special report by scanning the QR code or click the link in the description to get your free access. Finally, we've got a stock you probably never heard of before. I'm talking about Betterware de Mexico with the symbol of BWMX. It is also a new addition to my Zen investor portfolio. Just scan the QR code to see the rest of that hand-picked stocks I'm holding right now. Betterware operates a direct-to-consumer platform selling home organization, kitchen, and food solutions across Mexico. Think Avon meets the Container Store. It's an asset-light model where you combine direct selling without heavy inventory costs, and that's crucial because it means higher margins and better cash flow. But this is the part that is really the wake-up call. Wall Street analysts forecast 60% or greater upside potential for the stock in the year ahead. And here's a bonus on top. They just announced a $250 million acquisition of Tupperware's Latin American operations. This strategic move greatly expands the growth potential into new areas in Latin America and greatly expands the upside potential for shares. And here's what most people miss. Management has a proven track record of successful integrations. They know how to make this work. The current business model has proven scalability. They're generating growing margins and robust free cash flow. Their primary operations in Mexico exposes them to a growing middle class with increasing consumer spending. Let's look at what the Zen ratings and Wall Street actually say about Betterware, because this is where it gets even better. Not surprising, the Zen ratings smiles on Betterware with an A rating, which translates to a clear, strong buy recommendation. But that's not the big headline. BWMX is actually our number 1 ranked stock in the entire retail industry. Not number 10, not number 5, number 1 out of 39 retail stocks we track. The component grades are also exceptional. A for financials, A for artificial intelligence factors. Now that's the biggest surprise, as you wouldn't expect so much safety from a small cap growth stock based in Mexico. Coming down the home stretch, it scores healthy B ratings for both growth and value. This is a well-rounded fundamental profile that only adds to the appeal of these shares. On the analyst front, coverage is limited as you would expect for a smaller international company. Yet the 2 analysts on the case both see the same thing, pointing to a table-pounding strong buy ratings. That's 100% consensus with an average target price of 25. This includes Eric Beater from Small Cap Consumer Research, who's in the top 22% of all analysts. He recently reiterated a strong buy rating along with a price target that shows a full 60% upside from current levels. Whereas the analyst from Freedom Capital Markets just initiated coverage making this critical point. Investors are overlooking the FCF despite growing margins and robust free cash flow. In other words, the market is missing the tremendous growth and value story here. Let me be straight about the risks. This is a small cap stock with $705 million market cap, so liquidity and volatility can be issues. Mexico's economy faces headwinds from trade policy and political uncertainty. And the direct selling model is mature in most developed markets. This isn't a slam dunk proposition. But here's why it caught my eye. This is the number 1 rated stock in retail industry that is generating serious free cash flow. Plus, it's positioned in a growing market with a scalable business model. It's a tad risky and may not be for every investor, but it absolutely deserves a closer look by both growth and value-oriented investors. So there you have it. 5 stocks with serious upside potential, backed by Wall Street's top analysts and confirmed by the Zen Ratings quantitative model for fundamental attractiveness. Drop a comment below and let me know which of these 5 stocks interest you the most. And if you want even more great stock picks, then check out these 3 under-the-radar selections that deserve your attention now.